Welcome to this video where I will be recording the answers to the All-Star exercise that you have been busy with. Here is the brief. We read the 2 years of data and the intention was to complete year 1 income statement and balance sheet and year 2 income statement and balance sheet. And now we are going to review the numbers. So let's bring in the income statement. And we're going to start with the 2017 year. Some of the numbers I will skip through pretty quickly because they are quite straightforward, and others I will spend a moment on because there's a little bit more complexity there. So to start off with, the sales of 4 million was given to us in point number 1 of the case, and you just had to fill that in the sales box. There was a point of information about the sales where they said it's all on credit, which really just implies that our customers don't pay us cash when they take the goods. They pay us at some point in time in the future. And if you read further down, you would have got to point number 9, where they said that actually on average customers take 44 days to pay. So that's information that we need for a little bit later. But for now, we put the sales in here of 4 million, and we move on next to the cost of sales. They said to us in point number 1, 80% of this 4 million was paid across to suppliers, and hence that's where this 3.2 million comes from. And the remaining 20% here, which is the 800,000, is kept as a gross profit in the business. They then said to us, or they then provided us with some information that you really just had to plug in. The general and admin, they gave that to us in point number 4 as 85,000. And also in point number 4, they told us that the selling costs were 7.5% of the sales. And in point number 6, they told us about this fleet of vehicles and that the depreciation for the year is 225,000 Rand. So you plug those numbers in there, you can add them up, put the expense at the top here, and 800,000 minus the 610 gets us 190,000. They said there's no debt in the business in 2017, so therefore there's no interest expense, so the profit before tax remains unchanged. The tax number was 35% of the profit before tax. So that's 66,500. Subtract that to get an earnings after tax of 123,500. And then calculate the dividend, which was 20% of these profits. So we calculate that, we subtract it, and we end up with this retained earnings number of 98,880. So now that we've completed the first income statement, we're going to head over to the balance sheet and complete the numbers in the balance sheet. So I'm going to start off at the top and I'm just going to follow the order as I've done up until now. So the ordinary shares is 200,000. Now I know there's some data in the case that might lead you to think that perhaps this number is 1 million. But if you read carefully, it tells you that the authorized share capital of All-Star is 1 million. And notice there's no rands amount in front of that. That share capital actually represents share certificates or shares that are available. And if they are sold to a shareholder, for which the company receives money from the shareholder, then you can put that money, per se, into the balance sheet. You can only record on the capital side the money received from shareholders. So since 100,000 shares were sold to Ashok and Praveen, each getting 100,000 at 1 Rand, this is 200,000. All right. The retained earnings is a cumulative number, and you had to be sure to incorporate the information in point number 8, where they told us that the retained earnings from the previous year, in other words, if we had another balance sheet here to the left of 2017 that represented 2016, the retained earnings from there needed to roll over and then you needed to add to that the 98,800, this number from the bottom of the income statement. You had to add that in to find the new retained earnings. So the key word there is cumulative. Add up the share capital and the retained earnings to get a total equity number. There is no debt, but normally we would add the equity plus the debt to get a total capital number. At this point, if you want, you could take this total capital number and you could move it all the way down and plug it in under the net assets, because these two must balance. All right, so the fixed assets, moving on, the fixed assets is 450,000. They called that the net book value at the end of 2017. And net book value implies that it has already been depreciated. So the 225,000 has been deducted. In point number 3, they gave us the stock information. And then point number 9, remember that about the debtor days? That's the information we need to use to calculate this debtor days number. So the formula that I used to get this was to take the original sales back here of 4 million and divide this number by 365. So think about what that does. It calculates the sales per day for the year. And once you've got the sales for one day, you can multiply it by 44, and what you've calculated here is 44 days of sales. Now that's an estimation. That's not a precise number, so it's not the right way to do it. But what I'm trying to introduce you to here is this concept of debtor days, and also how to calculate it, because when we get into the financial analysis, we're going to be using debtor days and creditor days and stock days and all those sorts of terms in order to measure the business. So it's just planting a seed for now. The cash number at this stage, we don't know what that is. So we're going to have to come back and resolve that later on. So it's written here in red, but let's just assume that we leave it blank for now. So let's move on to the creditors. 232,800 that was given to us. It was the sole supplier that we owe. And then they told us that there's no bank overdraft, so that we can put that number as 0. That allows us to add these two numbers up and get a current liabilities number. So really, we are only missing one number. We are missing this cash number. And to resolve that, we really just need to solve for cash. So for now, I'm going to plug this number in here, 43,408, and I'm going to show you in the next video, or when I've completed the following year, how we do those calculations in order to solve for cash. But for now, the cash number is unknown, and I'm really just solving for X, or the unknown number, in order to complete the balance sheet. Really what we should be doing is we should be doing a cash flow in order to understand the cash that came in and the cash that went out in order to reconcile that number. But we will get to that as we progress on our journey here, looking at income statements and balance sheets. So let's move on to the second year. So here we're in 2018, and first up we need to complete the sales. Now you've got to concentrate here a little bit, because there are actually two pieces of data that relate to the sales, and they are contained in item number 4 and 5. So we have sales from ongoing agency business. That gets us the 3 million of the 6 million. And then we have the sale of mattresses, where we sell 5,000 mattresses at 600 Rand each. And that gets us another 3 million Rands worth of sales. So you've got to put those two together. And then each of the sales items have their own cost of sales. So the 3 million that came from agency business has an 80% cost of sales, and the mattresses that we sell have a cost price of 380 Rand. And if you multiply that by 5,000, you get the cost of sales for the mattresses. So you need to calculate those and then bring them together in order to get this total sales less cost of sales, which gets you a gross profit of 1.7 million. And if we move on, they gave us information that said that the general and admin costs had gone up to 120,000. That is in point number 7. The selling costs as a percentage of sales, that was reduced down to 3% of sales, and that was contained in point number 6. Depreciation requires us to consider the fact that there are two different assets now. The fleet of vehicles from last year, this 225,000 in depreciation, is a recurring depreciation cost because we are using the vehicles in the 2018 year. But in addition to that, we've acquired a new asset. And this new asset, this 1.2 million rand asset, which was the manufacturing plant for the mattresses, we bought that at the beginning of the year, and for the sake of this exercise, we are assuming 1 year's worth of depreciation. And the 1.2 million is depreciated over the 4-year contract, and that information is provided in point number 3. So 1.2 million over 4 years is 300,000, and when you put 300,000 together with 225,000, you have the depreciation amount. Add up our expenses, subtract them from the gross profit, and we have an operating profit of 875,000. Next up, they said to us that we are taking on this debt. We got R1 million worth of debt to buy the manufacturing plant, and with that we have a interest expense. This information is contained in point number 12 of 162,000. So subtract that to get the profit after tax. The tax hasn't changed. That is 30% of the profit before tax number. That subtract out the tax to get the profit after tax. Then we need to calculate the dividend, and in this case the dividend has increased to 40% of the earnings after tax. So calculate the 40% of that number and you are left with retained earnings of 278,070 rand. Take this number across to the balance sheet. Add it to the existing retained earnings to get the new retained earnings. Remember, that is cumulative. Alright, so they told us a story about a transaction that's happening between Ashok and Pravin. One of the shareholders is buying from the other shareholder and paying him, I think the number is 400,000 for those shares. Now in this transaction, what you need to ask is, does any money come into All Star or go out of All Star because of this transaction? And of course, this is a transaction between what we would call third parties. In other words, it doesn't involve the business, it involves the shareholders. So there's no change to the ordinary shares in the business, hence this number stays at 200,000 because no money comes into All Star. So yes, the share price has changed, but a change in share price doesn't change the capital in the business. So add the two equity numbers together, the ordinary shares and the retained earnings. These two get us 1 million and some change. Add that to the long-term debt. Debt plus equity gets you a total capital number of just over 2 million. Take the total capital number, bring it down and plug it in under the net assets, force your balance sheet to balance. Next up is the fixed assets. So we have the 450,000 from last year. That's got to carry over and be depreciated. So the 450 will go down by 225,000, which is the depreciation for the fleet of vehicles. So that will get you a portion of the fixed assets, that will be 225. And then there's the 1.2 million that must be depreciated by 400,000 to get down to a value of 900,000. So this depreciation number is made up of 900,000 rands worth of manufacturing equipment, and 225,000 rands worth of fleet of vehicles, and add those two together to get the fixed assets. All right, so from then on, the information for stock and debtors and cash was all given to you in the statement, in the data. You just had to find the number and plug it in. You can add all those up. You can get the current assets there of 1,250,000. The creditors, that was 232,800. They said to us it's the same as last year. Now that doesn't mean we haven't paid them for a year. It's a coincidence that the number turned out the same, but it's as a result of us paying them and receiving goods and paying them, receiving goods, etc., and it turned out to be the same number. All right, so the one missing number now is the overdraft. In fact, the statement said they didn't know what the overdraft was, and you are to work it out in order to get the balance sheet to balance. So this is solving for X, if you want, solving for the missing number. And again, I'm going to show you a calculation how to do that in an upcoming video. All right, so there we have all the numbers complete. And just a recap of the process that I followed. So having read the data, you might have been tempted to take different pieces of data and then go and find a home for it. In other words, where do you put this? Where does it go in the income statement? Where does it go in the balance sheet? My process is to follow the format of the income statement, completing each line item, going back to the data to find the information. Once you've completed an income statement, move on to the balance sheet and then complete that, moving from one year to the next in order to find all the data. So I hope your confidence is building and you feel like you can do some of these numbers. I will make available to you several other examples of an all-star type case where you can practice and get better at doing this. It's the only way that you can come to terms with these numbers, learning and understanding financial statements, is actually to do them. See you in the next video.